In this ultimate video course, you will learn everything you need to know about supply and demand for trading stocks, forex, crypto, or any other financial market. By watching the full course, you will not only be able to trade supply and demand like a pro, but you will also gain the edge to profit in both bull and bear markets. Alright, so hello everyone and welcome to this ultimate supply and demand trading course. This course I'm super excited about because, as you will learn throughout this course, supply and demand is the force behind all price movements. And in this course we will go through in a step-by-step manner everything you need to know about supply and demand. So yeah, this will be a pretty long video, so make sure to get cozy, maybe, grab a coffee before you start, maybe even grab a notebook, because this course will be packed of value and I really want you guys to get the most out of this course. So do whatever you need, but make sure to really lock in. And one super quick thing I can also mention before we start here is that I have built this course in a very step-by-step manner. So it's meant that you watch all of the chapters in this course in order, because each chapter will build upon the previous chapter. But I will also make sure to have YouTube timestamps so you can jump back and forth throughout the course. Maybe you need to rewatch a chapter, or maybe for some reason you want to jump over a chapter. You're totally free to do that as well. But as I said, I highly recommend to watch the chapters in order. But right, so now let's begin. And let's start here with a quick introduction to supply and demand. First of all, what is supply and demand? Well, supply and demand is the forces behind all price movements. So if you look at a price chart and you see the price going up, that is because supply and demand. If you see the price going down, that is also because supply and demand. Supply and demand is the core principle of all price movements, and that is why this course is so important. And as I mentioned, this course is meant to take you from beginner to advanced, and my goal is to, this course will probably be around 1 hour, maybe a little bit shorter, maybe a little bit longer, but my goal is around 1 hour course to try to pack it with as much value as possible. And here, this is super important. You will first of all, of course, learn what supply and demand is, but you will also learn why supply and demand leads to price movements. And this right here is what many other videos, trading videos on supply and demand, completely ignore. And this is a big mistake in my opinion. In order to trade supply and demand, it's so important to understand, how supply and demand works and why supply and demand moves prices, right? So it's very important to learn the what, the why, but we will also, of course, take a look at how to trade with supply and demand. How can we use supply and demand to make better trading decisions and as a result, make more money? But right, so now then, what is supply and demand? In order to trade supply and demand, we of course need to know what it is. Well, demand here is, in very simple terms, buying pressure. Demand is the force that pushes prices up. And the opposite is true for supply. Supply is selling pressure. It is the force that pushes prices down. And it really is this simple. When people, for example, say, you might hear traders say things like, we are seeing lots of demand at this zone. What the traders mean is simply that we're seeing lots of buying pressures at that zone. Or you might hear other things like, we're seeing lots of supply coming in right now in the market. That basically means that we are right now seeing lots of selling pressure in the market. A very easy way to think about supply and demand is to simply think about it as buying and selling pressure. So when you hear demand, think buying pressure. When you hear supply, think selling pressure. And here, and this is very key, when prices rises, this means that we have more demand than supply. And when prices fall, it means that we have more supply and demand. So price movements, from this we can learn that price movements comes from imbalances in supply and demand. And this is what we as traders can use, and you will learn all about this in this course. If we can find areas on the chart where we see, for example, strong imbalances, where demand is much higher than supply, we as traders can actually trade these areas and as a result make more money. So here, every chart tells us a story of supply and demand imbalances. So when you look at a candlestick chart, what you are basically seeing is all kinds of imbalances between buying and selling pressure. And now I want you to dive much deeper and take a look at how this works on the core level. Alright, okay, so now it's finally time to start learning about how supply and demand works. And to understand supply and demand, you need to learn about something known as the law of supply and demand. And to make this very simple, we can actually divide this into two laws. And let's begin here with the law of demand. And the law of demand simply states that the higher the price, the lower the demand will be. And this is a general rule. And this might sound a little bit complicated in the beginning, but don't worry, I think it will be very clear after this example. But right, so now I want you all to focus on this chart right here. This is what is known as a demand curve. And to make this very clear, let's think about this as a demand curve of chocolate bars. So on the y-axis here, we have the price. And on the x-axis here, we have the quantity demanded. So the quantity demanded is how many chocolate bars. And let's think about this graph. Let's say that up here, the price maybe is $10. And all the way down here, the price of a chocolate bar is $1. And let's think about this. Do you think people are more willing to buy chocolate for $1 or for $10? Well, the cheaper the chocolates become, the more people want to buy. So as you can see, down here where a chocolate bar is just $1, you can see that we have lots of people wanting to buy chocolate bars. But up here, where the price is of a chocolate bar is $10, you can see that we are not seeing lots of quantity demanded. Or in other words, not many people want to buy chocolate at this price. Maybe for $10, only rich people like, Elon Musk and Jeff Bezos wants to buy because they don't care about the price. But we normal humans, we don't really want to buy chocolate for, a small chocolate bar for $10. We much rather prefer it to buy it for $1. So as you can see, the cheaper the price becomes, the more people want to buy. But now then, what about the other law? What about the law of supply? Well, this right here is pretty much the same thing, but the opposite. The law of supply states that the higher the price, the higher the supply. And what we mean here is that the higher the price goes, the more people want to sell. So for example, if we once again think about our chocolate bar right here, let's once again think about that the price up here is 10 and the price down here is 1. If a producer or a store can sell chocolate for $10, that means that very many people want to sell. Why do so many people want to sell chocolate for $10? Well, because if you sell one chocolate bar for $10, that means that you can make lots of profit. Maybe the input costs of making chocolate is just maybe 50 cents, so $0.5, so that the producers up here will make 5.9. This means that the business is super lucrative and so many people want to sell chocolate for $10. But what about down here at $1? Well, if you can only sell a chocolate bar for $1, you will notice that much less sellers are willing to sell chocolate for this cheap price. Maybe in order to sell chocolate for as cheap as $1, you maybe need huge factories, so that you're able to produce lots and lots of chocolate for very cheap prices, and at the same time being able to pay your employees while still making a tiny bit of profit from the chocolate. But I hope you can see on this supply curve that the more they can sell, the more you can sell chocolate for, the more people in general are willing to sell chocolate. But right, so now it starts to get super interesting, because now we're gonna start learning about how supply and demand moves price. And to do this and make it a little bit more relevant to trading than, chocolate bars, let's now think about the supply and demand curves as supply and demand curves of the Bitcoin price to make it a little bit realistic. And here, as you can see, now we have both the supply curve we recently looked at and the demand curve in the same chart. And remember, the lower the price, right? The lower the price, the more demand, and the higher the price, right? The higher the supply. But here, and this is super important, let's say that we look at a certain Bitcoin price level. Let's say that we look up right here and that this price is $150,000. You can see that right now, as I'm recording this video, if we look at 150,000 US dollar, you can see that on this specific price level, we actually have more supply, right? This right here is supply compared to demand. We can look down here in the graph and clearly see that we have more quantity supplied compared to the quantity demanded at this level. And remember from earlier, when supply is more than demand, this will actually push the price down. So it will push the price down a little bit, but you can see that right here we still have more supply than demand. So it will continue to push the price all the way down to this point right here, where supply is the exact same thing as demand, and this is known as the equilibrium point. And the exact same principle is of course true when demand is larger than supply. So let's look at the Bitcoin price down here. Let's say that the price down here is 50,000, right? On 50,000, we can see that we have many more people willing to buy Bitcoin. We have much more demand compared to the amount of people willing to sell Bitcoin. So here we clearly have more demand. Demand is larger than supply. And as long as demand is larger than supply, we will push the price up. So here the price will be pushed up all the way until we reaches this point right here, which is the equilibrium point. So just by understanding this graph right here, I would say that you understand more than 90% of people about how supply and demand works. It really is this simple. More demand than supply, price will be pushed up. More supply than demand, price will be pushed down. And this is how supply and demand affects every single price chart you have ever seen. Okay, so now when you know about the demand curve and the supply curve, and you have a basic understanding of how these curves work together, now you are ready to learn about probably the most important thing you need to learn in this course to understand supply and demand, and that is demand shifts and supply shifts. If you want to trade supply and demand, this is something you can't do without. You really need to understand demand shift and supply shift. So what is a demand shift? Well, once again, let's actually go back here to our chocolate bar example, because I do think it's a little bit easier to demonstrate when it comes to chocolate bars, but this works for all assets. So it doesn't matter if it's chocolate, if it's Bitcoin, if it's, a stock, it doesn't matter. But here, a demand shift is when the demand for anything, like for example, chocolate, changes for a specific price level. So for example, let's imagine that a new scientific study just recently came out that said that chocolate is actually super healthy for you. A study like this would probably make many people not buying lots of chocolate, maybe, start buying much more. Maybe they start to buy chocolate every day. So what happens is that for a certain price level, so let's say for this price right here, let's say it's $5. For a certain price level, this shifts the demand curve to the right, because we're seeing more demand for this level. So our new demand curve maybe looks something like this. So you can see here, for each price level, we now have more buyers. We have more buyers because a study came out that said that chocolate is super healthy. But what you will notice right here is that because of this shift in the demand curve, we will actually now have a new equilibrium point. Remember, the equilibrium point is where the supply and demand curve meets each other. So you can see that the new equilibrium will actually be higher. So what this demand shift actually did was that it pushed the price up. Let's say that it pushed the price of chocolate up to maybe 7. So by just understanding this graph, you can realize that when we see a demand shift, this will push the price up. Or at least if we have a positive demand shift. Because let's imagine here, let me actually delete some stuff first. We can also imagine that in a parallel universe, the study actually didn't say that chocolate make us much more healthy. It was the complete opposite. The study said that chocolate is much more, toxic and unhealthy than we thought, and this will push the demand to the left instead. Because people that were used to buying chocolate here and there maybe think that, it's definitely not worth it anymore. I will stick to other types of candy and ice cream, but I will avoid chocolate. So this means that we will see, for example, here at $5, we will see less buyers down here compared to before. However, you will still see that you will still have many people willing to take the risk and willing to buy chocolate. Maybe they just love chocolate so much that they are willing to, risk it for the biscuit. But the important part to notice here is that when the demand shifts in the other direction, now we will have an equilibrium point which is lower, which maybe pushed the price of chocolate down to 3. But from a trading perspective, the most important part to learn here is that positive demand shifts pushes the price up. Alright, so the last thing you really need to learn if you want to use supply and demand to trade and make money is to learn about supply shifts. And let's once again imagine that the price right here is, $5 and a supply shift happen when for some reason at a certain price, producers can, or at least are willing to sell more chocolate. So this can, for example, there can be many reasons, but let's imagine that, a new technology is invented that makes people able to produce chocolate much more quickly and more cheaply. So this makes it that compared to before, where this much amount of people were willing to produce chocolate for $5, now we have many more amount of producers willing to produce chocolate for $5, and this actually pushes the whole supply curve up to the right. So we're seeing a positive supply shift. We're seeing more supply coming in to the market, and you can see that the consequences of this supply shift is, no surprise, that we get a new equilibrium. So here, the new equilibrium might once again be, at $3. And I once again want to emphasize that the most important thing you need to learn is that, a positive demand shift, more demand coming into the market leads to the price going up, and more supply coming into the market, like we're seeing right here, leads to the price going down. This right here is something you will need to have in mind throughout the rest of the course. But alright, so now when you know about the law of supply and demand, and you also know how supply and demand leads to price movements, now you are finally ready to start learning about supply and demand zones. And what are supply and demand zones? Well, these are zones we traders mark up on our chart, and we use these zones to trade. So we use these zones to find entry levels, target levels, and even where to place our stop losses. But here, in very simple terms, a demand zone is an area on the chart where we have more demand than supply, or even more simply put, you can think about it as an area on the chart where we have more buyers than sellers. And this leads to big price movements to the upside. A supply zone, on the other hand, is a zone on the chart where we have more supply than demand, and as you already know, this leads to big price drops. And a simplified way to think about supply zones is that we have more sellers than buyers. But now you might wonder, how are these zones created? Well, supply and demand zones are, in simple terms, they are institutional footprints, or at least partly. And what do I mean by institutional footprints? Well, the zones are basically footprints of large players, or another word for this is smart money. So smart money or institutional traders are large traders like, for example, banks, hedge funds, and other types of big players that have lots of money. But you might wonder, okay, so if smart money creates these zones, what makes the price react again when the price returns to these zones? Well, there are multiple reasons for this. And one reason is that institutions often can't fill all their orders at once. This will leave many unfilled buy and sell orders behind. So for example, if an institution buys lots and lots of something, let's say that an institution buys tons of Bitcoin and pushes the price up, the institution might still have many buy orders at this level waiting to get filled. So when the price returns to this level, these unfilled buy orders can actually give the price a new push towards the upside. So when the price returns, those leftover orders can get triggered, and it can lead to a fresh reaction. Another reason why these zones can lead to strong reactions is that if a large institution was willing to buy at exactly that level before, there are a pretty solid reason to believe that they might step in at that level once again in the future. So that is yet another reason. A third reason that you shouldn't underestimate is that when we see these very clear supply and demand zones on the chart, other traders remembers the strong move from that area and are likely to place new trades there. So this is almost like a self-fulfilling prophecy. So for example, people that watch this course right here might, in the future be able to identify one of these demand areas, and as a result you might take a trade which leads to even more buying pressure, which makes it even more likely that people spot these patterns in the future. So a part of, or I would at least say that a part of why this works is that so many traders are paying attention to these areas that can make them even stronger. Basically, the combination here of both unfilled orders and, very importantly, also trading psychology can make these zones, powerful reaction points. But alright, so now let's take a look at the different types of supply and demand zones. And the first demand zone that is very important to learn about is something that I call aggressive zones. And don't worry, we will very soon take a look at exactly step by step how to identify both aggressive zones and all of these zones. But what an aggressive zone is in simple terms is that it's characterized by sharp and strong movements to the upside. Many times when you see aggressive zones, you will find engulfing candles. You will also find something I called momentum candles, and also explosive imbalances between supply and demand. So aggressive zones are created, if you think about the chart we talked about earlier in the course, the aggressive zones are created when we see a very big difference between demand and supply, which leads to strong and quick price movements to the upside. The other zone you need to learn about is something called strong high/low zones. And these are zones that are specifically created at major swing points in the market. And don't worry, very soon I will show you guys how to identify these strong highs and lows, because these are the points in the market where we find the strong highs and lows zones. The next zone type we have to learn about is something called fresh zones. And A fresh zone is, in simple terms, a zone that haven't been tested yet. And we will take a look at that step by step. The other, last but not least, we have the tested zone. So this right here is, a zone that has been tested. And we will take a look at all of these zone types now, step by step. But alright, so let's begin here by taking a look at the aggressive demand zone. This right here is one of the most important supply and demand zones to learn about, because as you can hear on the name, it's very aggressive, so it leads to fast price movements. But a good thing about fast price movements is that it can lead to, fast and lots of profit, but only if you know how to identify them correctly and, trade them with correct risk management and all that good stuff. But let's begin here by taking a look at how to identify an aggressive demand zone step by step. So step number 1 here is that we're looking out for strong and aggressive moves towards the upside. And what I'm looking out for specifically is something called momentum candles. And a momentum candle is a candle that is at least twice the size compared to the previous candles. So for example, if you look at this green candle right here, you can see that this green candle, if we measure this candle, you can see that it is roughly 3 times the size of, these previous red candles, or at least it's, more than twice the size of the previous 3 candles. So this right here is what I'm considering a momentum candle, and that is the first thing I'm personally looking out for when it comes to aggressive demand zones. And here, it's important to mention that, different traders will have slightly different rules, what is an aggressive demand zone. Some traders even call it other things, but this is what I'm looking out for. The second sign here I'm looking out for to identify aggressive demand zones is that I'm looking out for something called bullish engulfing candles. A bullish engulfing candle is a candle that completely engulfs the prior red candle. So it needs to open below and close above the previous candle. And if you take a close look at this green candle right here, you can actually see that it opens below right here and it completely engulfs not only one candle, not only 2 candles, but it engulfs 3 candles at the same time. This right here is a very good sign that we might be looking at a strong, aggressive demand zone. Last but definitely not least here, what I'm looking out for is that it's not enough to only see one strong candle. The third thing we're looking out for is that I want to see strong follow through. And what I mean by this is that after this strong first candle, I want to see a strong follow through move towards the upside, just like we saw right here. All right, so great. In this case, we have a strong momentum candle. This candle was also a bullish engulfing candle, and we also had this nice follow-through move to the upside. So here we have good reasons to believe that this is an aggressive demand zone. And to really understand this, think about the law of supply and demand we talked about earlier, and also the supply and demand shift. In order to see these very strong price movements to the upside, there is no way to have these strong moves without seeing lots of more demand compared to supply. So something in the market happened right here that led to the demand shift. This can be as simple as, it might just be that a big hedge fund or big bank decided to step in and buy. Maybe they are done with some analysis and decided to buy, or they are using, algorithms that decide to buy if certain criteria is met. It doesn't really matter exactly the reason, but what we do know is that at that point in the market, we saw lots of demand coming in. So now we have enough evidence to draw our demand zone. And to draw your demand zone, what you want to do is that you want to draw an area here from where the aggressive demand move started. Then you draw the area here to the right and you mark up your chart something like this. if you guys are curious, but how exactly do I draw my supply and demand zones? Don't worry, I will show you guys exactly how to do this later on in this course. But for now, all you need to know is that you need to draw out a zone from the start of the aggressive demand move, and then you draw that zone to the right. And then the theory here is that since we saw lots of demand, we saw lots of buying pressure coming in the past, it's likely that we see lots of buying pressure coming in the future. Remember, this can be orders that didn't get filled during the first move, or it can simply be trading psychology, lots of traders paying attention to this demand zone. And in this example, we can see that the price went up, it traded like sideways for a while, we saw some moves right here, we saw a strong move to the downside, but you can see that once the price reached the demand zone, we actually saw some buying pressure coming in. The first bounce here was, not that strong, but you can see that each time the price came down to this demand area, we saw here a strong move to the upside, and then eventually right here, we saw this massive, aggressive demand spike to the upside. And now you of course might wonder, but okay, so I know how to find aggressive demand. How do I trade these levels step by step? Don't worry, we will talk about that soon. But before we do that, we of course have to also look at the aggressive supply zone. Alright, so now the time has come to take a look at the aggressive supply zone. And this right here is just like the aggressive demand zone, but the opposite. And if you guys want to, you can pause the video right here and try to identify some aggressive supply on your own using the same rules we talked about recently. Remember here that the first thing we're looking out for is that we're looking out for a momentum candle. That is a candle that is at least twice the size of the previous maybe 2 to 4 candles. It's not a super strict rule, but as a rule of thumb, I would like to see a momentum candle be at least twice the size, but preferably 3 times or even larger. And if we look here, you can, one candle that really sticks out, at least in my opinion, is this massive red candle right here. You can see huge bearish momentum candle. This one is, at least 5 times the size of all of the previous candle right here. So here we have a clear bearish momentum candle. The next rule here is that we're looking out for engulfing patterns, and when it comes to the aggressive supply zone, we're looking out for bearish engulfing patterns. And you can see that this red candle right here, it super clearly engulfs, pretty much all of these candles is engulfed right here. So that is an amazing sign that we're looking out for strong selling pressure, or in other words, an aggressive supply zone. The third thing here to look out for, remember, we don't just want to see one candle. Preferably, we want to see a strong follow-through move. And in this case, you can see that we did. Yes, we saw this strong red candle right here, but we also saw some very nice follow-through supply coming in. So in this case, in this aggressive supply zone, we had all of the 3 signs happening at the same time. That is a very good sign. So now we have enough evidence to draw out our supply area. And to do this, we draw a zone here around the candles, or around the start, the origin of the supply area. And then we draw out this area here to the right, just like this. And you can see that the price came down, we came up, and once we reached this supply area again, we saw this massive move to the downside. And to be a little bit more specific, right here we actually saw something super interesting. This right here is what is called an LG, which stands for liquidity grab. This right here is when the price quickly pushes above a supply or demand area and then sharply reverses to the downside. In this video, we don't have too much time to dive into liquidity and liquidity grabs and liquidity sweeps, but luckily I do have a full course on liquidity trading concepts, so I highly recommend that you check that course out after this one. But as I said, we saw this liquidity grab and then we saw this move towards the downside. And one thing I personally like to do is that after we see a test of a supply zone, we can actually adjust the area a little bit to catch the origin of the next move. So this right here was the next move, and to catch the origin, we do want to draw a new supply area around the liquidity the liquidity grab we saw right here. So the next zone might look something more like this. As I said earlier, don't worry, I will show you how to draw supply and demand zones very soon. But you can see that the price went down, we came up here, we tested this supply for a while, and then we saw tons of supply coming in, and the price completely crash to the downside. But right, so before we can start taking a look at our next supply and demand zone type, we need to learn about something called strong highs and strong lows, because these types of supply and demand zones only appears at strong highs and strong lows. And before we can learn about strong highs and strong lows, we need to learn about a concept called break of structure. And in this video, I would just keep this very, very short and sweet. But if you want to learn more deeply about break of structure and something called change of character and market structure in general, this right here is actually a market structure concept, but luckily I do have a full course about that, and I will make sure to link that course both in the video card as well as the description. But in very, very simple terms, a break of structure occurs when the price breaks to a new high in an uptrend. So for example, right here, you can see that the price pushes to a new high in an uptrend. So this is a break of structure. Another example of a break of structure is right here. This is a break of structure because this is where the price pushes to a new high. So in an uptrend, a break of structure is when the price pushes to a new high, but the opposite is true in the downtrend. In the downtrend, a break of structure is when the price pushes to a new low. So this right here is a break of structure. Once again, this right here is a break of structure, and so on and so on. And strong highs and lows, make sure to really pay attention. Strong highs and lows comes from the point that caused the break of structure. So all of these purple points right here are strong highs and lows. So for example, this one right here is a strong low, right? And this one right here is also a strong low. We can write SL. This right here is a strong high. Why? Because this is the high that caused the break of structure. This right here is also a strong high. Why? Because this is a high that caused the break of structure, and so on and so on. And actually, for this course, this is all you need to know. A strong low causes a break of structure to the upside. A strong high causes a break of structure to the downside. But right, so now let's take a look at the strong low demand zone on a real life chart. And I can actually also just mention that it doesn't matter if you are, day trading and looking at maybe a 5-minute chart or a 50-minute chart, or if you are swing trading and are looking at 1 hour or daily charts. The concepts covered in this video can be found on all asset types and all time frames. What you do want to make sure of, however, is that you're trading something with sufficient liquidity. So I once again recommend that you check out my liquidity course. It will be in the video card as well as the description. But here, to identify the strong low demand zone, we first of all need to understand the trend of the chart. And if you are just looking at this chart, is this chart in an uptrend or a downtrend? Well, hopefully you can pretty clearly see that we are in an uptrend, right? You can see we have an impulsive move right here. The price pulls back. We see another massive move to the upside. The price pulls back a little bit. We see a move to the upside. The price goes back. Then we fail to print a new high right here, and the price once again start to pull back. And now, an exercise you can do right now is to try to find the break of structures on this chart. Remember, a break of structure is when the price breaks to a new high in an uptrend. So this right here is a break of structure. Once again, when we break above this high right here, this is yet another break of structure. However, last but not least, is this a break of structure or not? Well, if you look closely, you can see that at this point, the price actually failed to break to a new high. So this is actually not a break of structure. But right, so now then, you know that the strong lows comes from the moves that causes the break of structure. So for example, right here, we have a strong low, right? Because this right here was a move that caused a break of structure. And once again, this one is a bit harder to, realize, which of these points is the actual low. But once again, this was a point that caused a break of structure. So we still have to see this as a strong low. However, and this is very key, it's not enough for, for us to have a strong low to consider it a strong low demand zone, because we also need to see a strong move to the upside. So in this example, you can see that this strong low right here, from this low, we actually saw a very nice move towards the upside. We had multiple strong and green candles, and we saw a nice move. For the strong low demand zones, you don't have to be as, as restrictive as with the aggressive demand zone. So you don't have to have momentum candles, and you don't have to see engulfing candles, but in general, you still want to see a strong move in order to draw out your demand zone. If you, for example, look at this strong low right here and look at the following move, which we can see right here, this is definitely, at least in my personal opinion, not a strong enough move to draw out your demand zone. But as I have mentioned earlier, these are just my rules for supply and demand, and all traders will have slightly different rules and slightly different, ways to handle both aggressive and strong low demand zones. But this is how I do it. So in this case, once again, we draw out a demand zone that looks something like this. We draw it to the right, and you can see that the price pushed up. We pushed up even higher. We failed to break a new high, but then eventually the price came down to this demand zone, and this was where we saw a massive explosion to the upside. And if you traded this strong low demand, you could have locked in some nice profit. All right, so now let's shift the attention and take a look at the strong high supply zone. The first thing we need to do once again is to identify if we are in a downtrend or uptrend. In my opinion, this chart right here is much harder to analyze than the previous chart. But what you hopefully can notice is that at least this part right here are a pretty clear, downtrend, right? So two highs we're interested in analyzing is this high right here and this high right here. Let's start by focusing on this high. Is this high right here a strong high or a weak high? Well, remember, in order for it to be a strong high, we need to break the previous low. And in this case, you can actually see that the previous low comes from this point right here. So from this high, we actually failed to break the previous low. So this right here was actually not a strong high. This right here was a weak high. We can write weak high right there. However, the next move you can clearly see, clearly breaks the low right there. So this right here is a strong high. And since we're seeing a strong high, this might be a point where we see a strong high supply zone. But remember, and this is super important, in order to have a strong high supply zone, it's not enough to have a strong high, but we also need to see a strong move to the downside. And if you look at this chart, we can actually see that after this strong high appeared, you can see that we had a massive move to the downside. And remember from earlier in the course, in order to see selling pressure this strong, we need to have lots of more supply than demand. This supply can either come from a supply shift, like we talked about earlier, and in real markets, this can be, for example, large institutions stepping in and selling a lot. Or it can sometimes it can be new information, like a news event or something like that, that causes the supply shift. And remember, after the supply shifts, the price once again seeks the equilibrium level and the price adjusts. And in order to that, when it comes to supply shifts, the price needs to adjust to the downside. So once again, in this case, we mark up our supply area like something like this. We can see that the price went down here. We saw a move towards the upside. And then right here, once the price reached the supply, we saw a strong move to the downside. Once again, right here, we saw some move to the downside. And last but not least, the price right here actually tried to break above the supply area. But once again, the bears took control and we saw tons of selling pressure coming in to the market. Alright, so now let's switch attention a little bit and take a look at a topic that can really enhance your supply and demand trading. And that is fresh versus tested zones. And this right here is a topic that I feel like many traders are overcomplicated. This is a topic that is pretty simple, and let's just walk you through fresh versus tested zones step by step. So first of all, what I want to do here is that I want to identify a clear demand zone and a clear supply zone. And hopefully you can see that right here we saw lots and lots of demand coming in. How can we see this? Well, if we look here at the first candle, what type of candle is this? Well, this right here is a clear momentum candle, right? Why is this a momentum candle? Well, we can clearly see that the candle is more than twice the size compared to the previous candles. So this right here is a strong, aggressive demand. We can also see that we had some very nice follow-through candles right here and here. And last but not least, we can see that this green candle right here engulfed, at least a few candles. As for our supply, you can hopefully see that right here we had an insanely strong, lots and lots of supply coming in. This right here is a clear example of aggressive supply. And as you know from earlier in the course, these are the kind of moves that comes from these supply shifts. So for some reason, we're seeing lots of supply coming into the market. This is often due to smart money, or in other words, banks and hedge funds stepping in and selling a lot. But let's begin here by drawing out our demand zone. What we do here is that we draw it out. It looks something like this. We draw out the demand. And here, and this is very important, this right here is a fresh zone until we see this zone being tested. So this zone is fresh until we get the first test. You can see we have a test right here. The price came down and we saw a pretty solid, bounce here to the upside. So the zone is fresh until this purple part right here. After this purple part, it is a tested zone. And you might wonder, what is the difference here between fresh and tested zones? Well, in general, these fresh zones are considered to be a little more bullish. They are a little stronger, so preferably we want to trade fresh zones. However, you can also trade tested zones. Tested zones can still be great, but in general, we say that the fresh zone is preferred over the tested zone. So in the case of this supply area right here, we draw out the supply area. Is this right here a tested or a fresh zone? Well, this zone right here is of course fresh because it hasn't been tested yet. So this fresh zone right here is a perfect example where we can wait for the price to once again come up to that level, and hopefully we get a reaction we can trade and make some nice profit from. But right, so now let's switch the attention to how do we draw our supply and demand zones correctly. This right here is a question I do get a lot, and it is a very important question because so many, traders seem to be confused by this. So let's go over it step by step. Hopefully after this, you will realize that it's not actually hard. It's very simple. And here I will show you guys at least what I do. So what I do is that I use the rectangle tool in TradingView. I will show this step by step. And I have two different methods. Method one here is to use the last candle before the move. I will show you exactly how to do this. The second method is to include a cluster of candles. And I tend to include 2 to 3 candles. You also want to make sure to always cover the extreme wick, because this shows where the sort of imbalance, the supply and demand imbalance, began. And as I also briefly showed earlier in the course, I like to adjust my zones if a false breakout or new info appears. Alright, so now let's actually jump into TradingView. TradingView is the platform I personally use for all my technical analysis. I actually use it for all my fundamental analysis as well. I think TradingView is the largest technical analysis platform in the world. And if you for some reason haven't gotten started with TradingView yet, you are in luck because I do have a special link. You can use this link to try out TradingView Premium for free for 30 days. And if you, after the free trial, decide that you want to continue on your premium plan, you will get a $15 bonus. So make sure to check that link out so you can follow along. But now I want to show you guys how to draw our supply and demand zones in TradingView. And to do this is very simple. You want to navigate here to where it says geometric shapes. You press right here, and then you want to open up the rectangle tool. To use the rectangle tool, you simply just draw it out anywhere on the chart. And if this tool doesn't look exactly like mine, don't worry, you have the settings right here. You can change, for example, the border. You can change if you want a middle line or not, and you can change the background color. Feel free to, customize this tool however you like. I like to keep it gray. I feel like that's a good color on my white TradingView. But right, so now let's actually focus on how to draw our supply and demand zone. And I can also just mention real quick before we start here that we are currently looking at a 4-hour chart. We're looking at Bitcoin here on the 4-hour. You can see it up there. And you can see that we are right now in a live chart. But the first move I want you all to focus on is this move right here. You can see that just recently we have been seeing some strong demand coming in for Bitcoin. And I would actually consider this to be aggressive demand. Why is this aggressive demand? Well, once again, let's think about the principles. Principle 1 here is that we're looking out for a momentum candle. And this candle right here, even though it doesn't look that big, you can see that it's clearly bigger compared to all of the previous candles. So this is actually a momentum candle. So we have sign 1. Sign 2 is look out for bullish engulfing patterns. You can actually see that this candle engulfs all of the previous candles. So that is yet another bullish sign. And the third sign we're looking out for here is the follow through. And you can see that we saw amazing follow through. So here we have identified some clear aggressive demand. And now it's time to draw out our zone. And let me actually move the chart a bit here and make it a bit bigger so we can clearly see here. So I open up the rectangle tool, and method number 1 here is super simple. What you basically do is that you take the candle, the previous candle that happened before the demand started. So in this case, it is this red candle right here, and you simply draw the zone out. What I also like to do here is that I like to include the wick of the candle that started the move. So this right here is how, method number 1, how to draw out the demand zone. Method number 2 here is also pretty simple, but what you now do is that you want to use a cluster of candles. So instead of using only the red candle, now you want to include the 3 candles that happened before the move started. So our second demand zone, you want to include the wicks as well. Hopefully you can see our second demand zone. I can actually delete this before. Our second demand zone would look something like this. And here, and this is very important, when it comes to drawing supply and demand zones, I have been, watching quite a few videos on how other people do it. And I get a little bit irritated because we have many people saying you should draw your zone exactly like this. Some people say that you should, not include the upper wick, or you should include, only the lower wicks, or, they are super strict on how to draw their zone. And I definitely think that that's not the way to do it, because in real markets, when we are trading in real markets, these zones are not perfect zones. There's no magical way to draw these zones. That is why I think that it's not super important which method you use. But what I think is important is that you choose one method and stick to it, because that makes it much easier for you to, track your trades, to backtest, and so on and so on. Choose one rule. I recommend to either choose the 1 candle rule or the 3 candle rule and stick to that rule. Don't worry about people saying that you should do exactly like this or that. It's not really how market works, at least in my opinion. But right, so now let's switch the attention a little bit here and take a look at some of the best supply and demand trading strategies. And the by far most common trading strategy, which is also which can be very powerful if you know how to use it correctly. And I will show you a step-by-step example of this in TradingView very soon, and that is reversal trades. So that is basically to look out for entries at demand zones and look out for to sell or to short at supply zones. Shorting is basically when you bet that the price will go down. You can make money from falling prices as well as you can make money from rising prices. And I do have a video about shorting if you want to learn more about that. But another common trading strategy is trend continuation. And this is where the strong low demand and strong high supply comes in. We can find these strong zones in trends. So in, for example, uptrends, we can find zones at strong lows and we can trade the pullbacks to these zones. Another common trading strategy is to trade ranges. So sometimes we have a clear trading range. That is basically when the price trades, between a supply and demand zone like this, and you can try to trade the reversals. This is a bit rare to have a perfect range, but sometimes you will find them in markets and they can be good opportunities. You also have something called breakout and retest. So you can actually trade when the price breaks through a supply or demand zone. This can be a little bit more complicated than normal breakout strategies, but it can definitely work. And last but not least, I just want to remind you guys that you always want to place a clear stop loss. The most common way is to place it just beyond the zone and to have a target on either a opposite zone or to use a fixed risk to reward ratio. All right, so now it's finally time to put everything we have learned in this course together in a step-by-step supply and demand trading strategy. We will take a look at where to enter, where to place your stop loss, and where to lock in profits. All right, and step number 1 for this trading strategy is to identify our supply or demand zones. And if you are just looking at this chart, you might, think that maybe this right here, this looks like some strong demand, right? However, one sort of thing that is not really good about this demand is that you see that this candle that started the demand, or if you consider this one, you can see that these two candles are not really, twice the size compared to this red candle. But remember here from earlier in the course that if this is a strong low, we can still consider this a solid demand zone, a strong low demand zone. But to do that, we need to first analyze the trend, and hopefully you can see that we are in a sort of uptrend right here. I know it's hard, but in real markets it's hard as well. This is how the price usually looks like. It's very seldom we have this sort of perfect, beautiful looking trends. But if you look closely right here, you can interpret the trend like this. You see an impulsive move. The price sort of pulls back down here. Then we see a new impulsive move, right? We see a pullback. Then you can see this whole move right here as the next impulsive move, right? So for example, right here, what is this? Well, this right here is a break of structure, right? What is this? Another break of structure, right? The price pushes higher. But then, the price falls down, falls down, falls down, falls down. However, remember that when we see a break of structure, this right here will be a strong low. This right here will also be a strong low. And when we see a strong low, we don't have as strict rules as when we're looking for purely aggressive supply and demand. So because we have a strong low, this demand zone is a strong low demand, and we can use that to draw our demand. So let's zoom in here, and you learn from early in the course how to draw your demand. In this case, I definitely think the easiest way and the way that makes sense is to use the previous candle. We make sure to include the lowest wick of that candle as well, and then we drag out the rectangle here to the right. And as you can see, we saw a beautiful bounce of this demand. But here, and this is very important, usually we don't want to trade based on only the demand zone. In order to improve our odds of winning, and as a result, our odds on making money, it's usually a good method to combine multiple bullish variables. So one thing we can do is something called multi-time frame analysis. So remember, right now we are on the daily time frame, but we can actually zoom in here a bit, either to the 1 hour or just the 4 hour time frame, to try to get some better entries. So now we are on the 4 hour time frame, and we can see here that the price came down to our demand. Then we saw the price struggling here for a bit, and it was actually not until this massive green candle right here, this green momentum candle, that the move towards the upside started. So this was probably, you know, the best entry candle right here. Another reason for this is that we actually had a sort of short pattern right here. You can see this right here is something we call a falling wedge. And a falling wedge is a bullish chart pattern indicating a reversal to the upside. So now we have a demand zone, that is our first bullish sign. We also have a bullish short pattern. And 2 bullish signals is a good sign, but what if we can find even more bullish signals? Well, one of my favorite indicators to use is an indicator called the RSI, or for short, Relative Strength Index. And so let's actually open this one up. And when it comes to the RSI, you can use the RSI in many ways. You can, for example, measure overbought and oversold conditions. But one of my favorite ways to use the RSI is to look out for divergences. And a divergence is when the price goes in one direction and the indicator goes in the opposite direction. And here, if you look very closely, you can see that here the price is pushing down. But if you shift your attention to the RSI, you can see that the RSI pushes up. So the price is printing lower lows, the RSI is printing higher lows. This right here is a bullish divergence indicating a reversal to the upside. So here we have yet another bullish sign indicating a reversal to the upside. And we can actually see if even the volume was bullish. I'm not even sure here. Let's take a look at the volume as well. I need to delete some stuff so you can see. And actually, if you take a look here, you can also see that we had some amazing volume coming in. The more volume we have, you can see the volume bar is this green bar right here. It was the highest volume in a very long time. And the more volume we have, the more buyers are supporting the move. And remember, since we are at a demand area, we expect, you know, a big demand shift. And in order to have a real demand shift, we need to see volume coming in, because if we are not, then our theory is not really correct. We need to see lots of demand coming in at this zone. And as you can see, we can see that by looking at the volume. So here we have so many signs at the same time happening. So this is a very nice trade. As for our entry right here, the most common way to entry is at the candle close of the candle that started the move towards the upside. In this case, it's this green candle right here. And the stop loss, I have 2 methods here. Either set the stop loss below the lowest point, so below the low of the red candle. I hope you can see right here, below the low right there. Or if you want to keep it simple, you set the stop loss below the demand zone. As for your target, you can either use a fixed risk to reward ratio. So for example, a fixed risk to reward of 2:1, which means that the green area is twice the size of the red area, would have looked something like this. You would have locked in some nice and quick profit. But what you also can do is that you can use market structure to set your target. So for example, if we look at this chart, we see that it looks like we had some sort of resistance coming in right here. So it's possible to have a much wider target level all the way up there. But keeping it simple with the 2:1 would have looked something like this. And you would have locked in some very nice profit. But right, guys, so this course is getting super long. I think we are approaching 1 hour. I do have quite a few more things I want to cover. But I think I will wrap this course up right here. But if you didn't know, and if you want access to this full presentation I have been using today, as well as, you know, all of the charts and all like that, I actually published that for all our YouTube channel members. If you didn't know, we have a membership right here on YouTube where I share presentations like this one right here. I also share exclusive videos. You will get, you know, priority replies, and at the same time you support the channel. So if you want to support the channel and at the same time get access to this presentation and lots and lots of more content, consider becoming a channel member by clicking join down below. And now guys, your trading journey is just getting started. In order to improve your supply and demand trading, I highly recommend learning about market structure next. So when you have the time, check out this course. I will see you over there very soon.